When headlines are filled with war, global conflict, and the White House is posting missile strike highlights,
You want to see me do it again?
it feels obvious to say that it might not be the best time to invest. In this video, I want to break down how markets have historically performed during times of war, why they don't always perform exactly how people expect, and then why trying to sidestep the volatility can actually backfire badly. And at the end, I'm going to give you 4 quick tips to remember before making any war-based investing decisions. Let's get into it. Before we take a look at the first study, I just want to say that this topic can be kind of tough to talk about and controversial in some ways because war is terrible no matter how you frame it, and there's always the human tragedy side of that is very sensitive, and it's terrible what goes on during war. But in this video, I really want to focus on the investing side of things. When it comes to money you have invested, there's kind of 2 things that you have to separate. One is that emotional side that we talked about, your reaction to ongoing events. And then second is the actual financial side of it and remembering how markets have actually performed historically. Most investors assume that global conflict is automatically going to lead to terrible long-term stock returns, everything is going to tank, but history shows that that's not really the case. Getting into the first study was actually a CFA Institute analysis that looked at World War II, the Korean War, the Vietnam War, and the Gulf War, and the results were actually very surprising. War did not actually lead to weaker stock market returns, and they actually led to higher returns. And the most shocking part of the study is that the volatility of markets during periods of war was actually less than the long-term average. Taking a look at this chart, shown in blue is the return of each index over the full time period from 1926 to 2013. The risk row shows the annualized standard deviation during that period. Below this row in orange are the findings from the war periods that were studied. The returns for the wartime periods are calculated as a return of the index 4 months before war and during the war itself. And as you can see, the average returns for large and small cap stocks were actually higher than the long-term average at 10% and 11.6%. And like we mentioned, volatility actually averaged to be less during periods of war than when compared to the average of the index. That's the first study, but if you still aren't convinced, here's another one that was actually done by Fidelity and came to a very similar conclusion. Their study looked at a variety of wars as well, including the Iraq invasion in 2003 and more recently the Russian invasion of Ukraine in 2022. Fidelity does note that conflicts can trigger market swings, especially when they impact oil and other major commodities. But over longer periods, even historically, these events have not been major market drivers. They also note that there's little relationship between war and overall market performance because typically market performance is tied to corporate earnings. And in some cases, especially when it comes to the defense industry, corporate earnings have actually increased during times of war. Specifically relating to the war in Ukraine, which has resulted in thousands of lives lost and is a terrible tragedy. On the investing side of things, the S&P 500 is actually up over 50% since that invasion in 2022. So from these examples, we can kind of see how the stock market is always pricing in conflicts. It's pricing in the impact to economies across the world. It's pricing in interest rates. It's pricing in future earnings. All that is going into the pricing of markets when these global conflicts are taking place. So while war definitely creates fear and terrible headlines, it does not automatically destroy the long-term earnings potential of hundreds of global businesses. Now, to be clear, this is not me saying that war can never hurt markets. It absolutely can, especially if a conflict disrupts global energy supply or one of those major commodities that we talked about. It can absolutely trigger a market sell-off. But that does not automatically justify panic selling because now you run into a major problem, which is actually trying to time the market. And this is where most people make the mistake that costs them thousands. Fidelity looked back at markets and when down days were, when up days occurred, and showed that if you missed just the 5 best days from 1988 to 2024, your overall return would have dropped by 37%. Think about that. Just 5 days. That's not 5 years. That's not 5 months. That's 5 days over a 34-year time frame that if you missed, you would literally miss out on thousands, hundreds of thousands, potentially even millions of dollars, depending on how much you're investing. A JP Morgan study actually adds another critical piece here. They found that 6 of the 10 best days in the market actually occurred within a 2-week period of the 10 worst days. And 5 of the 6 best days happened directly after one of those worst days. Tying this to a hypothetical example, if you take a $10,000 investment from January 2006 through December 2025, it grew to about $80,000 if you just stayed invested. If you missed the 10 best days though, that number drops to $35,000, and this reduces your overall return to around 6.6%. That puts it in black and white the cost of trying to be fancy in volatile markets, which can be tempting because there's all these scary headlines and everything else, but that is exactly why every investor needs to know these 4 rules before the panic sets in. The first one is obvious. That is zoom out. We just looked at a number of studies that tell us that war does not destroy the long-term potential of the market. The second thing is to remember that volatility is normal. You are investing in the stock market. On an average year, the average pullback in the stock market is around 15% if you look at the S&P 500. And this is during normal years, not when there's a global conflict. So know what you're signing up for, and know when you start investing that volatility is part of it. You don't have to look at your portfolio every day. Make your investments, lock your phone, turn it off, accept volatility as part of the risk of investing. The third thing is the biggest risk, which is not actually the war that is taking place, it's actually your behavior. Because if you miss the best days in the market, like we looked at, you are going to significantly hurt your returns over the long run. And fourth is to stick to a repeatable process. The easier investing is for you, the more consistent you are going to be, and the less tempted you are going to be to make one of these crazy changes to your investment strategy that could hurt your long-term performance. So stay locked in, keep your strategy simple, and that will avoid the temptation for you to make any changes. All that said, I hope you found this video helpful. If you are serving or have served, thank you for your service. If you haven't yet, hit the like button and be on the lookout for the next 2 videos that pop up right here. You might enjoy one of those if you like this one, and I'll see you in the next video.